So now Mark's been talking about closing gaps. So where the market has gaps in either direction and then the gap fills. What I want to talk about is fading the gap fill, where we could be buying or selling from the gap close. So what we find in trending markets, often traders will look to buy the previous day's closing price in a stock or in a stock market if we've gapped up, or sell a market in a trending market if we've gapped down. So the market needs to be trending. And the reason for this is that there is potentially value in that area. Now, why is there value in that area? Now, if you think about it, that if we were in a massive uptrend in a stock or a stock market, and the following day the market opens a lot higher, do you think that you as an individual or institutes looking to get into the market want to buy at that higher price? Probably not. If your coffee was 10% more than it was yesterday, you might want to wait for the price to come back. And that's exactly what happens in the market. It's another market function trade, where often we see the market coming back to fill the gap, fill that function which Mark's been talking about, and then the gap being bought up, which we call fade of the fill. Now, the setup for this trade is a buy or sell from the previous day's closing price. Again, we're going to look at that ATR. So 15% ATR, and it's important just to note that that is a 5-period ATR of the daily chart. So you could get that, you could look at a cash chart on TradingView, or perhaps stock charts, and you could work out the ATR from there and take 15%. So in this scenario, we're going to use 15% ATR stop and 15% ATR target. Again, just reiterating what Mark says, the strategy is adapting to the volatility of the market. Because of 5-period ATR, we're looking purely at the last week. Over the last 5 days, stock markets are only open for 5 days. So what's been happening with the volatility for the last week? And we're going to take an average of that. Now, this trade can work on many markets. Your home market, the ASX, the NASDAQ, the Dow Jones, the S&P, the FTSE, and I often trade this in the DAX. So let's have a look at an example. Maybe we get a little bit of participation here as well. Now, it's a chart of the DAX, and what we can see here is that this line here, it's a half-hour chart of the DAX, by the way, and this line here is just pre the market open. The yellow line is the closing gap. And what do you think the market's doing here? Do you think it's trending up, or is it trending down? Not a trick question, that one. Trending up or trending down? What do you think? Okay, you people have got it. Yes, up. The market is trending up. So it's been trending up since the previous day. So around maybe, not much after open, maybe 10 o'clock the previous day. It's been trending all of the way up. And this is where it's closed. So now we're opening quite a bit higher than we were on the previous day. So one, there's an opportunity for a gap, a gap trade. And two, there's an opportunity to get into a buy trade from the previous day's close, as traders, institutes may not see value at this price. Often market makers also want to push the price back to the close, as they know orders will be filled around these levels. So let's have a look at the example of this. So here, over here is the open. Market moves down towards the gap, moves right into that closing price on the yellow line here. We blind buy this, by the way, guys. We just get into the trade, and we're going to have a 15% ATR stop. In this example, it was 26 points. So the market moves down, and then we're going to target 26 points, and the market moves up here. So can often be quite a quick trade. You'll probably be thinking, why don't we look for a reversal? You can look for a reversal, but often you might find that the market's already done the 26 points very, very quickly. Hence why we want to look to just buy and get in, and then maybe potentially manage the trade from a technical perspective after that. Perhaps once we've seen an example of a reversal, perhaps we could look to maybe tighten our stop below there. But pure market function trade, we can see here pre the gap, the market's bounced, taken out maybe the early buyers and moved up again, come back for another, and look at that pin bar, and the market's off again. Equally, this is a short-term trade, but it could be traded for a swing trade as well. Certainly, if you're looking to get into a longer position, perhaps you could get in, take half profits, and then run for the day if that ties in with your trade plan for the day. But this as an isolated trade can be very, very quick, and also can be set and forget as well. You could set this trade up, leave it, and see what happens in the day. Always, if you do have trades in the market or orders in the market, just a tip from myself, I always, if I've got orders in the market, I always place an alert at that level, or alert just before that level, to let me know that that order is potentially going to be triggered, so you can go back to the charts and watch the charts. Okay, so that is Fade of the Fill.